Hello, everyone, and welcome to the Stanford Brown SB Talks podcast, where we explore various elements of your financial world. Today is Tuesday, April 13th, and we're again catching up with our Mercurial Chief Investment Officer, Ashley Owen, to discuss investment markets, multi-trillion-dollar stimulus, central bank targets, and the outlook for the year ahead. Welcome,
Fantastic.
Ashley.
Can't wait.
Let's get into it. Now, Ashley, in recent weeks and months, we've had Biden's $1.9 trillion coronavirus support package, followed by a prospective $2.3 trillion infrastructure bazooka. Not surprising, therefore, in recent weeks and months, the trajectory for global markets have been broadly positive.
Yes, the COVID, biggest recession since the 1930s in pretty much every country around the world, hit share prices very quickly and very suddenly, but then they were instantly sort of turned around by wartime-like stimulus packages and promises and commitments by governments everywhere, including Australia, US, Europe, UK. So share prices are driven back.
You've done a very interesting piece in your latest monthly report, breaking it down across different sectors and looking how they behaved in 2019, which was a very healthy year for markets, 2020, which was sort of a tale of two cities, and then into this calendar year.
Yes, the last year, the stimulus, because economic growth is so slow or negative in a lot of cases, the stimulus was basically put into people's pockets, and the household spending increased, but household savings rates increased a lot more. So people were sitting on more cash. Incomes around the world exploded, and they had to spend it on fewer things. They couldn't go on travel. They couldn't. So things like cars and office renovations and home offices and gyms.
Quite concentrated, the spending. Yeah.
So a lot of the online spending, Amazon captured something like 48% of global online sales in that period, which is just extraordinary. So online sales, a lot of the afterpays did well. Those sort of tech sort of ideas that lose money, but people throw money at them anyway. So a lot of the speculative stocks did very well last year. Tesla was up, hundreds of percents, etc. And this is a turnaround this year. All of those Apples and Teslas and Afterpays are down, not down much, down there half a dozen odd percent, but they were up hundreds of percent last year. So it's been a bit of a turnaround in what's done well last year versus this year. So,
something of a rationalisation a little bit.
Yeah, people, meanwhile, the last 6 months, bond yields have been rising. So that means that longer-term interest rates are rising, and people are expecting cash rates to rise because the Fed and the RBA, etc., will have to start raising rates maybe sooner than they promise in 3 years' time. And that's caused people to change their view of these future fantasy land valuations that these technology companies have been priced at. So all of those are down by modestly this year, while the rest of the market's been quite good this year. Other things like oil and gas stocks were hammered last year because of the negative oil prices and the oil price collapse. So they've done, oil and gas was up 20-30% this year alone. So
sort of this time last year,
they've
we
done
had
well.
the OPEC standoff.
Correct. So we've had a crisis in oil and gas. So the OPEC got the shock of their lives when they saw negative oil prices last April. So I think that will be the end of the whole, that they'll now get together much more consciously and support the oil price, and which they've done over the last year. The other sector has done very poorly last year and very well this year is banks, because banks were sold down probably too much last year in the fear of this great flood of tidal wave of bad debts and bankruptcies.
Yeah.
So far, that tidal wave of bankruptcy has been held back by government stimulus.
It's quite interesting. There's been a few articles in recent weeks. So obviously, JobKeeper being the main arm of the stimulus here in Australia.
Yes.
And there'd been a lot of speculation as it rolls off that the liquidators would need to man up heavily. But the tsunami hasn't quite hit yet.
No,
early days still.
All liquidation firms around the world and in Australia were hiring frantically exactly this time last year. And they hired literally thousands and trained up thousands of staff to go into liquidations. They all went on JobSeeker because there were no liquidations. In fact, last year was the lowest year for decades for company bankruptcies in Australia and around the world, because they're supported by these artificial packages. That JobKeeper's one you mentioned, about 3.8 odd million people were paid JobKeeper at its peak last year. That ended at the end of March, and at that point, only about 1 million or less than 1 million were left on it, and the rest were either working Uber drivers or Deliveroo, or on the working some other sort of part-time or casual job, or not looking for work. They've given up altogether. So the actual number is down. So unemployment rate has dropped back to 5-ish%, 5 point something, 8 or 9%. So I suspect that the COVID crisis is a long way from solved in Australia and other markets. So I suspect there may well be second sort of double-dip recessions or slowdowns as support measures are wound back. But lockdown, Europe, UK is still in lockdown as of last week after another 4 or 5 months, and half of Europe still in lockdown in various stages, plus India, Brazil, all those emerging markets are still in their first wave. It's still getting worse. So the COVID crisis is far from solved. So governments,
in terms of the real world,
are running out of money or running out of the ability and in some cases the willingness to spend money endlessly to support that. So there may well be a bit of a disconnect this year. Plus you've got bond yields rising because of longer-term inflation fears. So there's a few things happening which means that you're not going to get the great rebound continuing into this year. Not unlike 2009 was a great rebound after the GFC, but that stopped flat in 2010 when bond yields started to rise. So it's a very similar period to that.
It ran hard for a period of time and then tracked sideways for a couple of years, really, with a couple of crises along the way.
That's right, the sovereign debt crisis. So it's a similar sort of thing that happened 12, 13 years ago with the GFC, just slightly different government responses to it. Government let markets fall and they were reluctant to spend and go into deficit mode. This time around, governments are running up wartime debts in order to spend their way out of the problem. So that's a different in policy response this time versus last year.
Yeah, so obviously markets have been boosted. Their trajectory's been set by the stimulus that we've had. What do you think might be some of the reality checkpoints that cause the markets to pause for thought or have a correction?
The most concrete one is bond yields rising. Which is basically people, we've seen that from about August last year, bond yields around the world, particularly the US, which is fundamentally a strong economy, putting aside cycles. So the US bond yield, Europe's dead, but even European bond yields have been rising. Japan's dead, but Japan's bond yields are back to zero from negative. So that's causing people to say, well, hang on a minute, cash rates will rise in the next year or two or three, or at least the Fed will start talking about winding back QE and then going into QT, quantitative tightening, to reduce the balance sheet and then maybe raising rates, as they did in 2018, far too early. So that sort of thing will scare markets from time to time.
Yeah, so a lot of it around not necessarily that rates are going up in terms of central banks, but the speculation that the trajectory is going to have to change. And they've sort of set targets. If you look at the 3-year bond yield through to 2024.
Yep.
We had some discussions around whether we think they're going to be able to hold that line for as long as they currently project.
Yes, the RBA has sort of discovered it was keen to jump on the bandwagon of QE and go to Jackson Hole, Wyoming, and hobnob with the other central bankers, so it had to play the game. So it's now buying more bonds every week than the government is issuing in order to contract the market to crunch to keep the prices high, which is completely artificial. But they are buying up 3-year bonds, Commonwealth government bonds, in order to keep the rate at 0 or 0.1%, which is their target. Yeah. Every now and again, it sort of drifts above there, and they have to step in more with more bond purchases. So all of which is artificial manipulation, but that's what they want to do. It's just the government issuing itself debt, so it's free money for them because the interest on the debt, the debt's raised at 1 or 2%, but they simply, the interest is paid to the RBA, which pays it back to the government, so it is literally free money. And they'll keep doing that until the wage inflation rises to more than 3%, which is its target, and it says that'll only occur when unemployment is below 4%. Now, Australia, last time unemployment was below 4% in Australia was 1974, and inflation was 16%. So you be careful what you wish for if you hope for unemployment under 4%. Unemployment will drift down faster than people expect. Don't forget that this time last year, people were saying we're going to have 20-30% unemployment, and it'll be there for a decade. That was solved a lot by these artificial packages to take people off the unemployment numbers and to pay them money.
Major safety net in terms of stopping business collapse.
But meanwhile, companies are hiring. I mean, with this business here, we've got 50 staff, and we hired 10 last year, 10 or 11 last year, just during COVID lockdown. So business is growing. So that you see that around. There were some industries like air flight and travel, for example, have been hit hard, but they're isolated. Most companies, the people like CEOs I talk to, their problem is they've got plenty of orders, but they can't get the orders filled. They're having trouble getting factories back to production. They're having trouble hiring staff. They're having trouble getting stuff into Australia. Yeah. So demand is there and hiring's there. It's more a question of how to fill the demand.
Particularly because the demand has been quite concentrated in certain sectors. So demand for furniture or those types of products has caused blowouts in their supply chains in particular.
That's right. So more companies are hiring than firing, and that's putting aside job seeker and job keeper. So I suspect the unemployment will drift down probably quicker than most people expect. Plus you've got massive booms in iron ore production, coal production, LNG production, which is causing a lot of money come back to the government budget. So I suspect the budget will get back into surplus more sooner than the 10 years that they're predicting, a lot sooner than 10 years, may well be 2 or 3 years. So things will get better probably faster than most people expected a year ago.
Yeah, so just as you talk about that, the materials sector, in your analysis there, you've looked again at 2019, 2020, and demand stayed quite strong there, partially due to challenges in Brazil in terms of the shutdown of production there and then impact in South Africa. So Australia has remained one of the fewer suppliers. Yes. And no doubt that's obviously why supply to China has remained very strong in that space.
Yeah, that's right. So things like the Pilbara fly-in fly-out workers, that hardly had a blip all through last year. So the iron ore is getting on ships. You've got the odd cyclone, which is always a problem, but iron ore is getting on ships, getting out of the trucks onto ships and getting across to China, Taiwan, Korea. So iron ore, coal, coking coal, thermal coal, LNG, those are particularly strong because volumes are up and prices are up. So it's one of these great periods as Australia. Every now and again we have a great period where prices are up and volumes are up. So that's been very good.
2003 to 2007 period.
Great for revenue. So the old the price of coffee in Perth is always a good indicator. 10 years ago it was $2, and then in the boom it was $5, $6. You couldn't buy a coffee on the street in Perth for $6. Now coffee is expensive again because there's just so much money flowing around, and people have got so little things to do with it. So you can't fly to Bali, you can't go to Hong Kong, you got to spend it locally. So things like car sales are doing very well, clothing, hardware, retail, a lot of things are doing very well, which far outweighs the sectors doing very poorly. And it's just pure luck which business you're in.
And I guess the overall comment on that, as you touched on before, not all sectors have not all boats were raised equally. So when we compare the performance of some of maybe the active managers to sort of the passive indexes have certainly been boosted by the absolute standouts, as you've raised before. There are things like Tesla, and some of these companies have gone up many hundreds of %.
Yes, that's right. So when we pick funds, most of our philosophy is we try and pick higher quality portfolios and more robust portfolios. So if you take Australian market, you get Afterpays and Zeros and WiseTechs and all sorts of funny little things that don't make any money and never will. WiseTech does. But our managers generally will look past those valuation problems and look for more robust companies that are going to be around in 10, 15, 20
Free
years,
cash
profitable.
Flow, profitable income streams.
You'll find that our managed funds we choose have lower P ratios, high dividend yields, higher quality management and higher quality companies in them. Now, the upshot of that is they will generally lag because they don't get the benefit of the Teslas jumping 300%, but they will always, and did do last year, they will always do better in the sell-offs. So our managers that we choose generally and as a group and individually, every single one of them last year outperformed its index during the sell-off, as they did in 2011, as they did in 2015, and those that are around in the GFC did in the GFC. So the upshot of that is for portfolios, we've got the two versions, the index portfolio and the active portfolio. The active, I think both of them over the last 5 or 6 years are tracking pretty much the same, but the active portfolios will generally lag slightly in the mad booms like we're in at the moment, but they will more than add value in the sell-offs. So it depends on clients whether they want a smoother ride with more active management or they want to take slightly more bumpy ride, still better than the index over the long term, but that's a different shape of the portfolios.
Yeah. Okay, no, it's always an interesting insight there, and what we expect them to do in different different parts of the market cycle.
Yeah, we're looking after people's life savings as if it's their last dollars they've got left. In a lot of cases it is, so we're going to make sure we're not going to blow it up, and it's going to be there when they need it in 10, 20, 30 years' time.
For them and for their children and beyond.
Yep.
The other major asset class, residential property, has been experiencing an explosion in the last 6 or 9 months. We talk a little bit about that in our monthly update.
Well, interest rates, free money is pretty compelling. So I've got a little story in my monthly last month where I've got a copy of my bank statement from 1988 when I had my second house in Sydney. At the point I bought the house. And the Sydney median house price jumped 60% when interest rates went from 13 to 18%. And it took interest rates to get to 18%. And I got a copy of my bank statement to prove it in order for it to kill the boom. So the idea that interest rates rising, getting up to maybe shock horror 2 or 3%, that won't stop house prices going. House prices jumped 60% between 87 and 1990 when interest rates went from 13 to 18%. So people are now struggling to get a home loan now for 1.5%. You can't pay more than about 2% for a home loan. We got rates under 2%, and particularly fixed rates, 1, 2, 3 fixed rates with the RBA cash at 0. So people are gearing up. They've got nothing to spend it on. Household savings rates have increased. Household incomes have increased over the last year. So they're putting money into deposits, and banks are lending money. They don't lend money on anything else but housing because it's simple and brainless. And their house prices, people are talking about 20, 30%, which sounds a lot of growth over the next year, but I've lived through 2 or 3 booms where house prices double in a couple of years. And the medians jumped 60% in the late 80s, but the places we were in were doubling. And literally, we went through that and benefited from that. So a lot of people are...
Even from this mark, I guess, but in terms of affordability, obviously I know affordability is helped a lot by the ultra-low interest rates.
Sydney house prices are still just back to what they were in the boom in 2017.
In real terms?
No, we're just in the median terms, they're over $1 million in Sydney median, which is mad, but they were. And then the APRA came in with its credit controls in 2017, 18, 19. They crunched the market because the RBA was terrified of raising rates. So the APRA had to do it, and they limited LVRs. They had speed limits on lending, and they limited investor loans and LVR.
Much more detailed checking of expenses,
which stopped the boom. They then took the curbs off, and the boom started to go again. Then, of course, COVID hit, and then rates were dropped to 0. So I suspect the next move will be very similar to what Norway, Sweden, Switzerland, England, New Zealand did last week or two, and that will be regulators will start to impose lending controls because the banks have got to keep their rates at 0 for governments to borrow to fund their deficit. So the banks, the RBAs of the world, the central banks won't touch rates for a while. Therefore, the government will have to regulate lending in order to slow the housing price bubble. So the next step will be APRA will probably start to limit debt service ratios, loan-to-value ratios, and in particular, this particular boom is unlike European and New Zealand boom in that those booms are driven by investors. Yeah. In Australia, it's driven by first-home buyers. You've got all this money being thrown at first-home buyers and grants, and there's about...
Yeah, so I was going to say, it's quite interesting when you talk about prices being back at 2017 levels. I think it's certainly not equal if you take Sydney across the city. There's definitely some areas...
That's the median. There are pockets.
I think the areas of less supply are well in front of where they were, and then there's areas of much greater supply that are probably just still catching up.
Yes, but, same as normal. Close to the CBD, within 10 or 15k radius, blocks of land with houses, you can't go wrong. Population's rising, immigration will get back, natural population is rising, limited supply, you can't go wrong. Sydney, Melbourne, close to the CBD. Further out in other pockets, particularly things like the Blue Mountains, Central Coast, they've done well because people are now commuting. Yeah. So those pockets have done well along the beaches, along the good mountain stretches. They're rising as well around Australia. So I suspect that it's those sort of an hour and a half's drive from Sydney, Melbourne, and also just the central suburbs will be very strong because of supply and demand.
And I guess how aggressive do you think government might be willing to be? And I guess if you link this back to your prior point about what's happening with interest rates, the fact that they're going to be happy to probably manipulate for somewhat longer.
Yes,
it has the potential to get behind the curve and then have to have a scenario like that you discussed where they're having to go aggressively 4, 5, 6% rate increases over a period of time.
There was a period, one of the rules that APRA introduced half a dozen years ago to slow the boom last time was they had this 7% rule. Even though interest rates at 2%, 2.5%, you had to assess a home loan on the basis of a 7% rate.
i.e. is in the borrower's ability, ability to pay a 7% rate.
That's right. Not my 18% 20 years ago, but the 7%, which shock horror is a high rate in this current world. They took off that rule, and the boom reignited. Amongst other rules, they took off. So I suspect they will have to start doing those sorts of things. As part of their suite, I reckon we'll have, before the year is out, we'll start to have APRA imposing rules like that to start to slow the housing lending. Now, Australian households are the most and highest indebted households in the world, apart from Switzerland, I think, and Singapore, which are one tiny city markets. But as a nation, we've got world record household debt per household in the world. It's all based on housing. So the RBA's cunning plan is to lock everyone in at 3-year fixed rates at 1% and hope like hell that house price inflation will take prices up 20-30%, so that an LVR, loan-to-value ratio of 90% now, will suddenly become a safer-sounding 60% when house prices are 30% higher based on artificial rates. All of which is funny money, because then house prices aren't worth that, because the market rate of interest in Australia should be in the order of 3, 4, 5%, and therefore more in a given economy that's not in recession, and therefore mortgage rates should be 5 or 6, 7%, which is what they have been. So if you try and assume that sort of mortgage rate of 7% on a home loan, all of a sudden these people don't qualify. So RBA's cunning plan is to get everyone to go into hock, gear up for 3 years on an interest rate loan, and just cross everything, fingers, toes, and hope that they can inflate house prices 20-30%.
And
That's the plan.
And all the debt levels are relatively smaller.
Correct. Debt's higher in absolute terms, but in LVR terms, based on this fluffy number called the house price, it's a fascinating game. Meanwhile, I haven't had a home loan since 1998, so I'm just looking at this from the sidelines.
Well, it's just a delicate balance, as you articulate, in terms of their ability to do it without setting off a scenario that's very hard to then get back under wraps again.
Meanwhile, they'll all be retired. It'll be someone else's problem.
If you touched on it before, but can we talk a little bit about what we're seeing in the fixed income part of the portfolio? So you discussed sort of yields continuing to creep up.
Yep. So bonds are funny animals. So bonds are the traditional safe asset class, which are government bonds that have a regular coupon. They pay every half year, generally speaking, and they're fixed for the life of the loan. Bond yields for government debt around the world reached bottoms in about middle of last year, in the middle of the COVID recession. In Australia, a 10-year bond sold for about 60 basis points, or 0.6%. You can buy an Australian government bond and it will pay you 0.6% every half year for the next 10 years. Yeah. Same as the US, almost exactly the same as the US. They are now about 1+% higher than they were this time a year ago. So that means that you can now buy a bond, a 10-year government bond in most countries around the world for 1% more than you could last year. Still very poor returns, and if inflation rises, those returns will be negative, because if inflation rises to 3-4%, which is like a worst-case scenario, then you'll get bond yield, the actual value of the bonds reduce.
Capital reduction. Yeah.
So we don't hold a lot of bonds in portfolios. We have a lot of our fixed rate exposure is in floating rates, which actually benefit from rate rises. If rates are going to rise over the next 2 or 3 or 4 years, then floating rates.
The capital doesn't change in value, but the yield you get.
$100 doesn't change, but the yield increases because they're pegged to a rate which rises, like the 30-day bond yield or the 90-day bill rate. So floating rate, particularly high-quality credit, high-quality corporate debt is very attractive even at these current levels, because they will rise, yields will rise.
What sort of yields are we seeing there currently?
Well, cash on a term deposit, you can get less than 0.5%.
Correct. So it's all relative in comparison.
So it's all relative.
Yeah.
The RBA's cash peg is 0, and the 3-year peg is 0, or 0.1%. So on a high-quality corporate bond portfolio, which we have in our portfolios, you can get 2.5, 3%, without going into sub-investment grade.
Without getting into unnecessarily risky waters.
So, and they will rise. If rates rise 2%, that 3% will rise 2% as rates rise over the medium term. So we would favour, we've got fixed rate bonds in portfolios as a buffer against share solace, because shares may well sell off this year, and bonds will do quite well as they did last year and as in the previous years. But we would favour having more floating rate than we would otherwise have in portfolios, and almost all of it sort of high-grade, investment-grade stuff.
Now, closely related to this, you write about another piece in your monthly, which is unfortunately the number of scams that we're seeing sort of come to light in recent times. And what happens is typically in times of ultra low yield, you see a lot of things popping up that are promising eye-watering returns, and
yes, a lot of
sometimes
things,
too good to be true.
Unfortunately, the tech boom has thrown up a new category of animal called fintechs, which are these disruptors that are disrupting the banks and disrupting traditional payment companies. Most fintechs are based on a very simple idea, and they're just dressed up with a nice fancy new title. I remember in the 80s, I had a business a factoring business. You go in the company and you buy their invoices and you pay them a discount.
Yep. Okay. Buy the invoices for 90 cents.
You buy the invoice. You basically got an invoice, and you purchase the invoice. You take an assignment of the invoice, and you then pay the company the face value of the invoice, $100 invoice.
And you took the credit risk.
Minus 5% per month, which is about a 60% compound rate per annum. And we then collect the money off the client when it's due and payable in 30 days or 60 days or 90 days. At high risk but high return. This fellow called Greensill took this old 100 years old idea called factoring company debts and dressed it up, and he called it a fancy new name called supply chain finance. He raised about $10 billion from poor sucker investors around the world via the usual suspect investment banks, which peddle these things. Paid them about 10%, collected about 40% compound from these things. But it blew up over the last couple of months in March, and it turns out that it wasn't actually factoring at all. It was basically giving people free money on the basis of future invoices for future work done for future clients. It's madness. So that's caused a lot of pain around the world, and we knocked back a couple of funds 3 years ago now that were put to us, which were these factoring funds, and we said that doesn't make any sense. No one's got any idea what's in them. Turned out it was all fluff, and they've lost $10 billion, and it's in the papers today, and it will be for years and years and years. So it's a simple case of a simple idea dressed up as a fintech, sold by spivvy investment banks, and blew up spectacularly. And there's a lot of those around. We've seen the Melissa Caddick affair, which is a woman who masqueraded as a financial planner in
Castle Rock.
Across Castle Rock, which is the one across the road, up the way a lot of people know about. And they dress up, they just make up returns. In the paper today, there was a case of the Gold Sky scandal. Same guy, it's a guy, used car dealer on the Gold Coast or Kings Beach, just made up returns. He said he had $100 million in funds returning 20% per year, forged statements, collected money off investors, mostly sports people, as it turned out, sporting stars, including some famous swimmers and footballers. Complete scam, blew up. Now, the US SEC, the US regulator, closed him down in 2018. ASIC was asleep. Only today, or yesterday, in today's paper, ASIC said, we've got a problem here, let's chase him. So regulators are asleep at the wheel, and a lot of people... So it comes back to caveat emptor. You've got to understand what you're investing in. And most of these things, if you ask 2 or 3 basic questions, like ASIC will say, make sure they're licensed. Well, Castle Rock was licensed. He had an AFSL. Didn't have to forge it. The other ones forged them. He didn't have to forge it. So he's got a license. So what does an investor do? They say, well, that makes sense. I've got a statement here saying a 20% return. Where do I sign? He collected about $10 or $15 million in the northern beaches a couple of miles from here. And that's all gone. He just spent it all. It's all stolen. So there's a lot more of those out there that will come to light as COVID has caused, and people can't travel. In the case of 1 or 2, I don't name names, one of them was about to get on a plane, another scandal last month, and couldn't get on a plane, so was stuck in Australia and was busted, and it was... Anyway, people lost money. So innocent investors are losing a lot of money. Anything that, with TDs paying 50 basis points, 0.5%, if you're lucky, anything that's dressed up as a low risk 2 or 3 or 4%, let alone 10%, they're going to say, well, that sounds good. You know, Jim down the road's got into it, so I'll get into it. So it's easy to do.
Yeah, just always be mindful.
Be careful. Come and talk to your advisor at Stanford Brown, and they'll check it out for you. Literally every day or every week, I get half a dozen proposals I see put to us. Most of we laugh at, have a good laugh after hours. But some of them are dressed up to look reasonably good. Some of them look like Nigerian scams, and they are. dressed up as various funds that look good and sound good. They've got great logos and the returns are great, but they're forged. ASIC's got a website with a whole lot of forged bond scams, bonds from credible sounding companies offering 9%, 10% bonds, all just forged. So don't get tempted to chase yield where you don't understand actually where the money's going.
Now, April, end of quarter, starting to do the analysis in terms of the outlook and the potential rebalancing of positions. Anything you want to, obviously you're in the middle of that process, so I don't want to ask for anything definitive, but what are you seeing?
Well, share markets, which is most of the portfolios, they are at expensive levels on pretty much every measure. We use a lot of measures, all sorts of different aspects of valuations, different ratios, different metrics we use. Things like, simple things like the ratio of margin lending relative to the total GDP of America, margin lending in America versus GDP. Whenever it hits 3%, whenever margin loan volumes reach 3% of GDP, which I flag in my monthly report, quarterly reports, market sell-off.
Getting hot.
Happened this time last year, in the end of December last year, market sold off. We didn't know it was COVID, but you could tell one of these measures. Happened in 2018 before the sell-off, happened in 2007 before the sell-off. So every time margin loans in America reach 3% of GDP or higher, markets always have sold off. The only time they were higher when they reached 8% of GDP in the 1929, and it sold off for the next 30 years. So that's one little measure. We use about a dozen different measures of valuations of shares and a whole bunch of different metrics, and pretty much all of them are saying very, very expensive. It's very hard to fight the Fed. So with the stimulus being thrown at money,
3.3 trillion infrastructure bazooka.
Biden's 1.9 trillion he signed off in March. That was the CARES Act, which was the coronavirus support package, the continuation of that. That was got through Congress and he signed off in March. The next stage is the $2.25 trillion US stimulus, which has got a lot of things. It's infrastructure, clean energy, education for all, quite a lot of things, manufacturing rebuilding in America. So quite a lot of things in there. With a very tame House and Senate now, it's quite easy to get some of those through. So most likely a lot of those measures will be accelerated rather than put back. So that's very powerful. So money being thrown at all those sorts of things ends up in people's pockets. With restrictions still there, they've got to buy something. So you're going to see a lot of GameStop type things happening more with people throwing money at silly ideas. So I suspect that markets will remain quite positive until something occurs like a sudden relapse into recession because of lockdowns in America or something like that. Vaccinations, there's about 400 million people vaccinated around the world currently. About 3 men and a dog in Australia, but we're slow. They've got now about 7 vaccination types being run, not counting the Chinese and the Russian ones, which who knows what they are. But Europe is 30-40%. UK's vaccinated 40% of the population. There's still lockdowns in isolated areas, unfortunately, and there's new strains. The problem, I think, is you look at India and Brazil and most of the emerging markets, they are still in their first massive wave.
It's going to be a long time till they can get
herd immunity. Globally, and the whole problem won't be solved until the world's solved. Otherwise, borders won't open and activity can't back to normal. So globally, the third wave peaked in January. February, they started to come down. But you look at the last 3 or 4 weeks, even despite all these vaccinations, last 3 or 4 weeks, global infections has risen back up to about 600,000 per day. That's a lot. And global deaths are running now at about 50 to 60,000 and rising per day. That's per day. Mainly in Brazil, India, all across Asia, Southeast Asia, and all across Africa and South America. They're still in their first wave. So they are going to have a lot more problems this year, which we had last year. They haven't got the government support. They haven't got the medical support and the hospital network. So it's going to be quite a fair, and that's half the world's population. So we're not out of this yet. So it could be a scare. So markets are very expensive. So far, a lot of money is being thrown at them. Expectations of cash rates rising are reflecting in bond yields, which may well continue to rise. So those sorts of things will start to rattle markets from time to time. And at expensive levels, they can fall quite quickly.
Yeah, albeit potentially then rebound again. I guess we will see more in the weeks ahead.
Watch this space.
Thank you very much, Ashley, as
Fantastic.
always. Thank you, and thank you to all our listeners.
Good evening all.